One of these guys has leverage, a tenant, monthly rent, and a building he can drive past. The other one has an app on his phone and nothing physical to show for it at a barbecue. For the first 9 years, they are dead even. Somewhere around year 15, under this model, the guy with nothing physical to show pulls ahead, and the gap never closes again. That is not a twist ending. That is just what happens when you count every dollar, on both sides, for 20 straight years. This is real money decisions. The rule on this channel is simple. The math gets decided before the side does, never the other way around. We are not here to defend real estate or defend index funds. We are here to run the numbers and see what actually survives contact with real life. If that is the kind of channel you want in your feed, hit subscribe now. Let's get into it. Ryan and Michael are both 38. Same mid-sized city, same $82,000 salary, same $50,000 sitting in a savings account. From here, their paths split completely. Ryan puts his $50,000 toward a $240,000 duplex, 2 rental units, 1 roof, in a stable but unremarkable neighborhood. After closing costs, his loan is $192,000 at 6.9% on a 30-year investor mortgage. Principal and interest are roughly $1,270 a month. He rents both units, one for $1,050 and the other for $950, for a combined $2,000 a month. Against his $1,270 mortgage payment, that is $730 a month in cash flow before a single expense. Michael takes his $50,000 and puts it into a total stock market index fund. He sets an automatic transfer of $350 a month and mostly forgets it exists. These numbers are not predictions. They are model assumptions, so the point is not to guarantee an outcome. It is to show how sensitive the winner is to rent, rates, repairs, appreciation, and investor behavior. Here is what almost never gets said out loud. These two investments do not just perform differently. They feel completely different to live with. Ryan can drive past his building. He has a story for it. Michael has a number on a screen that moves a little every day and means nothing on any single day. When people ask what he is invested in, he says index funds, and the conversation moves on. That gap in feeling shapes the decisions both of them make for the next 20 years. Hold on to that. It matters more than either of them realizes right now. Let's stress test Ryan's duplex first. Then we will do the exact same thing to Michael's index fund. No favorites, same level of honesty on both sides. Rent is income. It is not profit. Profit is whatever survives after the property gets paid first, and the property always gets paid first. Over 3 years, Ryan collects $72,000 in rent. His mortgage payments total $45,720. Gross cash flow is $26,280. That is the number that sounds great at a barbecue. Here is what comes out of it before Ryan keeps a dollar. Property taxes are $9,600 over 3 years. Landlord insurance on a duplex is $6,000. In year 2, the furnace in the downstairs unit fails. That is $3,200, paid immediately, because nobody waits on heat in February. 1 unit sits empty for 5 weeks between tenants. Lost rent and turnover costs come to about $1,700. And then there is the call that does not show up on any spreadsheet. Thanksgiving weekend, year 3, Ryan's phone rings while his in-laws are at the table. A pipe fitting let go in the lower unit overnight. By the time a plumber can come out, the damage and repair cost $1,800. Total real costs are $22,300. Net 3-year cash flow is about $4,000 on a $50,000 investment, not counting a single hour Ryan spent managing any of it. If this is more honest than the version of this math you usually see, tap like. It is the only reason this kind of video reaches more people than the highlight reel version does. Now Michael, same honesty, same level of scrutiny. 3 years in, Michael's $50,000 plus his $350 monthly contributions have grown to roughly $77,000. Using an 8% long-term average return assumption for this model, that is an average, not a guarantee. No drama, no phone calls. But no drama does not mean no cost. In 2022, when inflation fears and rate hikes dragged the market down for most of the year, Michael logs in one weekend and sees his account down around 20% from where it had been 6 months earlier. There is no tenant to reassure him that real value still exists underneath the number. There is no mortgage quietly getting paid down by someone else. Just a red number and a decision: sell or do nothing. He does nothing. That sounds easy from the outside. It is not easy from the inside, and that is the actual price of Michael's path. Not a dollar amount. A test of nerve repeated every few years for 20 years straight. Michael also has no leverage. His $50,000 buys $50,000 of assets. Ryan's $50,000 is controlling a $240,000 building. That difference is about to matter a lot. Ryan's down payment did not buy him $50,000 in assets. It bought him control of $240,000 in assets. When the building appreciates, the gain is calculated on the full value, not just his slice of it. That is the entire case for real estate, and it is a real one. It is also exactly why this comparison stays close for a long stretch of the timeline, closer than either side usually admits. 9 years in, and this is the part that surprised me when I first ran it. Ryan's duplex, appreciating at a modest 3.5% a year, is worth roughly $327,000. His mortgage balance has dropped to about $168,000. His equity is approximately $159,000. Michael's portfolio, after 9 years of contributions at 8%, sits at roughly $155,000. They are, for all practical purposes, tied. One guy owns a building with 2 heating and cooling systems and a mortgage. The other has an app on his phone. And they are standing in almost the same financial spot. This is also right around where the lead changes hands. If you want to see exactly when and why, stay subscribed, because what happens next is the part most real estate versus stocks videos skip entirely. By year 15, Ryan's duplex has climbed to roughly $402,000. His mortgage balance is about $141,500. His equity is approximately $260,500. Michael's portfolio is roughly $280,000. For the first time, Michael is ahead. Not by a rounding error, but by about $20,000, with the gap widening every year from here. Nothing dramatic happened in year 12 or year 13. There is no single event to point to. It is compounding doing what compounding does. Ryan's leverage gave him a real head start in the early years. But Michael's gains have started generating their own gains, year after year. With no rent checks, no repairs, and no mortgage balance, quietly capping how much of the building he actually owns. Leverage is a head start. It is not a permanent lead. 20 years in, Ryan's duplex is worth roughly $477,600. His mortgage balance is about $109,000. That is $368,000 in equity on paper. But paper equity is not spendable equity. Selling costs run around 7% of the sale price, roughly $33,000. Factor in 2 decades of capital he had to feed back into the building. A roof, another water heater, another vacancy stretch, and Ryan's realistic walkaway wealth lands closer to $310,000 before personal tax specifics. That estimate assumes some of the property's cash flow over the years was reinvested back into repairs, reserves, and turnover costs, rather than kept as spendable profit. That is why the number comes in below equity minus selling costs alone. Michael's index fund, with $50,000 up front and $350 a month for 20 straight years, has grown to roughly $439,000 under this model's assumptions. His total contributions were $134,000. The exact number moves depending on contribution, timing, and how returns compound year to year, but the gap it leaves with Ryan does not change much either way. Michael ends up about $129,000 ahead. Not because real estate failed. Ryan's duplex still turned $50,000 into $310,000 of real wealth. But in this version of the deal, compounding without debt and without repair bills outran leverage with debt and repair bills attached. Move a few assumptions, and this flips. If Ryan's combined monthly rent had come in $200 higher from day one, his cash flow stops breaking even and starts compounding alongside his equity. Refinance into a lower rate, or buy into a market with stronger appreciation, and his $310,000 could easily be $380,000 or more. On Michael's side, the lever is contribution size. If Michael bumps his deposit from $350 to $500 a month starting in year 5, something a lot of people can do as income grows, his 20-year number is no longer around $439,000. Under this model, it moves closer to roughly $500,000 to $510,000. Neither path is fixed at the asset you pick on day one. Both are decided by what you do every year after that. Do not ask, is real estate better than stocks? Do not ask the reverse either. Ask, what has to be true for each path to actually work? A rental property looks unbeatable if you only count rent and appreciation. An index fund looks effortless if you ignore crashes and the urge to sell during one. Neither of those is the real version. The real version is Sunday afternoon math. The costs and the nerve that only show up once you are actually living inside the investment, not just looking at it on a spreadsheet. In this comparison, Michael's boring portfolio won. But Ryan's duplex still built real wealth, and a stronger deal could have flipped the entire scoreboard. The honest question is not which asset is better. It is which kind of work you are actually willing to keep doing for 20 straight years. Managing a property, or sitting still through every downturn that tries to talk you out of it. So, Team Duplex, Team Index Fund, or doing both? Comment below. I read every one. Because there is a version of this story we have not told yet. What happens if Ryan keeps the duplex and invests in index funds on the side? Or if Michael builds his portfolio first, then uses part of it later to buy real estate from a stronger financial position? That combination can change this entire scoreboard. That is part 2. Subscribe to Real Money Decisions so you do not miss it. We break down housing, debt, retirement, and investing every week, with the real math and no agenda. This video is for educational and informational purposes only. It should not be considered financial, investment, tax, legal, mortgage, or real estate advice. Everyone's situation is different. Past performance does not guarantee future results. Before making major financial decisions, do your own research and consider speaking with a qualified professional.